welcome everyone. I'd like to call to order the Finance and Investment Committee meeting. See what it is. It was Tuesday, February 17th, 2026 at 3:30 p.m. Glad you're all here. Thanks for being here. Is there anybody from the public at all?
There's nobody in the public.
Well, if not, let's get right into items for discussion. Review the budget to actual results.
And this will be all the finance team show, so I'm just gonna hand it over to Wes and let you can MC us through who's presenting what. So go ahead and get us going.
All right. Well, good afternoon. I'm excited. We're kicking off the 27 budget year.
Whew, already.
I'm not. I thought you were just in 26. Well, we got to start with the budget party page. And Jody updated because we're planning for 2027 up there on the right-hand side. That's the only change we make every year. That's the extent of our creativity.
Oh, boy. So why is the blue pig heavier than the pink pig?
That's the boy pig.
Just talk about the camera.
It's like me on camera.
Oh, I thought it was who's spending more. I thought it usually, but never mind, I'm not gonna go there. I got a bunch of timeouts. Then forget your girl math again.
Oh, you just went there. Oh, you said it.
All right. So moving on to the agenda, since we now have the audited numbers for 2025, we're going to go over the budget to action for 2025 as well as the previous 5 years. After that, we'll go over the preliminary budget calendar, start talking about some dates for future meetings and what we'll be working on during the budget process. And finally, Mike will go through the other post-employment benefits or OPEB plan, the funding and the status of the plan currently. So getting right into water, budget to actual for water for the last 5 years. We can see that last year, 2024, we did really well. We were 1.42%, a little bit over budget by $200,000 on a $14.3 million budget. So we were very excited about that. And then this year we looked at it and it said 5.25%. We said, no way, we can't lose to last year. But I did see that. And then we were looking at the variance of $786,000. And I joked, but we looked into it to figure out what caused the variance. And actually it was the result of the old SCADA project. As you may know, we had a project from 2020 forward, basically looking at the old SCADA system, trying to improve it, replace parts of it, and repair it, and basically keep it functioning. But ultimately, we determined it's just an obsolete system and really just needed to be scrapped. So now we have the new SCADA project, which I think is $8.4 million in total.
Over like an 8-year period. Yeah.
So because of that, the old project wasn't going to create an asset. We had to scrap it. So we had to expense it in fiscal year 2025. So that's for accounting purposes. And it doesn't mean that we actually had the expense in 2025. It actually, there were expenses from 2020 through 2025, but it all had to be expensed this year. So that resulted in about $700,000 in additional expenses in the IT department, which we couldn't have budgeted for, really planned for. So if you take that away, then you end up with 0.57% over budget or $85,000.
And just to kind of clarify that, so that $700,000 we expense is 5 years worth of expenditures. We didn't spend, there wasn't an extra $700,000 of checks or expenses that the district actually incurred. It's just from an accounting practice, we had to account for it in our expenses this year. So
Just in the 1 year only, you can't
well,
bring it, you can't
we did
expense it over a few years.
we would have normally, but it ended up not creating an asset. And then, and please correct me if I'm wrong, because I'm not an accountant and I don't play one on TV. But now that with the auditing rules, we said, okay, since we know we're not going to build anything now, so we had to expense all those years now.
Mm-hmm.
Yeah, so the way it works for projects is you actually book the expenses to an asset. It's called CIP, construction in progress, as you're working on it over the years. That's because you're planning on making that an asset. When it's completed and it's in use and it's location, condition, and intended use, then you actually credit the CIP and you debit the physical asset and you begin to depreciate it while it's being used over its useful life. So we were working on this project thinking it was going to create an asset that would have a future useful life. And we realized, oh, there's not going to be an asset. So then you have to take all the money that you spent and expense it in the year that you discover that it will not be creating an asset.
And just to clarify, this is, and Jason, you may know more about this than I do. This is when we were looking at trying to keep our legacy system going before we finally made the decision, you know what, it's going to be really expensive to keep that legacy. It's no longer supported. They're not making parts for it. So these were Band-Aids that we're adding to the legacy system over several years. So now we're building a new asset.
So we are still excellent at budgeting, budgeting. We're still excellent at budgeting and within 0.5% or $85,000 on a $15 million budget. Good job.
Yeah, I'd say most of the time, we know we're working on a project that's gonna build an asset, so it's pretty cut and dry. But occasionally there are those projects like the SCADA project where you have to pivot. It's kind of later in the game and it's dynamic, but that's fairly rare.
The big takeaway is it's not like the district spent an extra $700,000 this year. It didn't hit our revenue. It's not something that we expended and wrote checks where those monies were already spent majority.
Another thing we'll see, we're gonna see it in the presentation coming up. We also have projects off in that we aren't sure how much we're going to spend. We aren't sure when they're gonna be completed. So those might not even be projects or assets, but we'll put them to a project during the year. And then we determine the expense, which is usually at the end of that fiscal year, then we'll expense it. A lot of those are the condition assessments that we do for our asset management.
Yeah, and I'll give, Wes and his team credit. Every year we meet with engineering and really this is all communication, right? The accountants and the engineers got to talk and say, how is the project going? Is it progressing toward an asset? And so we have those conversations yearly. Occasionally a project we're not ready to make that determination, so it'll move a couple of years before we get that far. But I think we have a good plan in place to try to catch that before it happens.
Yeah, so a great example is we do a condition assessment, and let's say the pipeline is in perfectly good shape. So we're not going to extend useful life. There's not going to be any repairs. So then that gets expensed. We do a condition assessment, we find repairs, we find upgraded areas, and we schedule those repairs. Then that ends up extending the useful life of that asset. So then it becomes CIP and it gets booked out.
So looking at the total, 0.5%, $85,000, just to go through what that's, the analytics there, what it's made up of. First, I want to note that IT was actually under budget when you exclude the $700,000 by $39,000, and TS would be happy to hear that. And then next, pumping was over budget by $153,000. That's entirely as a result of energy costs. So 2000 and pumping is our largest energy portion of the expense in the district. And SDG&E had approximately 10% rate increases during the year, which we didn't plan for that much of a rate increase.
Yeah.
We did 2 of them.
Yeah, originally they come in around January, February, last year they said it's gonna be a 4.2% increase, and ended up being a 10. And we've talked about that before. They get 2 increases per year, and we don't know the second one.
So we're always going to be behind when we do our pumps on rates. But we'll end up catching up a little bit.
So does that track the extra energy, does that track with the extra water purchasing?
Well, in this case, we were right on track with our demand for water purchases. So we probably would have done better if the rates weren't so high. So mostly it's not
Mostly rate increase.
right, it's not demand driven as much as it is rate driven. Moving on to transmission and distribution, it was over budget by $106,000. That's a result of more main breaks this year than last year. And I talked to Eric, and we had 37 main breaks during fiscal year 2025. A couple of big ones. One was on Red Wing Street in September. Apparently there were contractors required to go out and we had customer driver restoration. That was $236,000 all by itself. So more main breaks and expensive ones.
Yeah, and as you know, those main breaks, it's really those pavement restorations really gets us. So
Road rebuild.
yeah, so the pipe issue, usually we can fix that pretty quick. It's not, it's the damage that it causes, and that's what really gets us.
So next, meters was under budget by $111,000. They were, in 2025, they were understaffed. So they were short staffed by 1 position for about 3 months out of the year. So labor was $81,000 less than budget. And then we were about $16,000 under in materials. They are now fully staffed currently, so that's a good thing. And moving on to engineering. Engineering was over budget by $224,000. And this one is one of those things that we kind of pre-warned you about. The ductile iron pipe condition assessment was a project that we planned for, didn't know when we'd spend it or how long it took. I think it was a 2020 project, and we finally wrapped it up. It was a just looking at pipes on several streets to see what the condition was. They finished it this year, so we had to expense the amount that was spent on it. And it was $187,000. 154 of that went to outside services and $21,000 to labor, but that's what put the engineering department over in their expenses.
Yeah, this is a project where we really expense it each year. This last year, it was more because we did more, but because again, we're not creating assets, it's almost like a study. You can't capitalize a study, but we have to study these pipelines to figure out what needs to be fixed, what needs to be rehabbed. This is just kind of the cost of doing business.
And the timing and the cost of these projects is just difficult to estimate, so we put them in there as CIPs and close them when we can, and then just note them during this process. And lastly, G&A was over budget by $239,000. This is mostly, almost entirely, more than entirely, as a result of less timed projects for water. So we had budgeted for about $1.2 million in overhead, and it came in about $700,000. So that really is a function of our budgeting for overhead, in which, whether it's going to be water or sewer related to the projects, because we do a allocation of labor, and we say, kind of estimate how much time we think the engineering department mostly will spend on labor on projects for the year. And it just happened that they spend actually more time on sewer projects, which we should probably know, but less on the water portion than we thought. So it's really just the overhead. And just to explain that further, as you know, overhead is deducted directly from G&A. So when the engineers charge the time to a project, that direct labor gets charged to the project, and then 2.1 times that labor gets taken out of overhead. So out of G&A in the form of overhead charged to the project. So we move it from G&A, actually move those expenses over to the project to cover the cost of overhead, to make sure we record the correct cost of the project. Does that hopefully I explained that okay?
You could, how much can you move over?
Only what we determine to be our overhead percentage each year. So each year we look at our indirect and direct
Based
costs.
on these percentages, with a 1.2 or the 2.1 or whatever.
Well, we calculate those based on our direct costs
Before
versus our
tax.
indirect costs. So every year we look at our indirect costs, we say how much is that in relation to our direct labor cost to projects? And it's 210%. So overhead here, lights, everything else we do that's required to run the district, 210% of that we need for the projects.
It includes benefits.
Has that been very consistent over the years?
Yeah.
Yeah,
I mean, it is.
it started like 195, 1.95%. Way back, that was probably 18, 17.
That was a while ago.
Some years it goes up by a few percentage points, others it comes down, but it's been pretty consistent.
Yeah, I've seen it go up and down, but it's been around 2 for a while. And then, really, if you look at the engineering workload in the CIP that's adopted, they're heavy on sewer projects. So it's what, this is on the water side. So how are we going to see the difference on the sewer side then?
I don't
Maybe or not too
think
bad.
we're actually under budget on the sewer side, but part of that.
That's my thing, they should be under budget, right, on the sewer side?
For G&A, they're under budget, but it's not as a result of the overhead.
Oh, okay.
It's something else. But one thing to note though is we are understaffed in the engineering department, and have been for quite a bit.
Oh,
So
yeah.
that could be one of the reasons for it as well. Less water projects, less staff.
Less staff charging full overhead rate towards that are booked towards projects.
So that's water. And now I'm happy to hand it over to Jody, who will go through the sewer section.
Quick, 2 questions on the water, sorry.
Yes, sir.
37 main break, you said, what do we use typically? You said that's a lot. What would we have in like 24 or
24, we
23?
had 31, 23, we had 23. That's fine.
So one of the big differences, the type of main breaks where we have to get contract, which is more expensive, but the committee members may recall, we got Trace Amigos pipeline done. And for a while, that was a main break a month. So a lot of them were not as expensive main breaks, but they were still a main break a month. So that does add up. So, granted, so my expectation, my hope is we'll have a lot less main breaks this year. But if you still have some big expensive ones, one on San Marcos Boulevard could cost way more than 20 main breaks in Trace Amigos.
Yeah. So, but it did go 23, 31, 37.
Exactly.
Gotcha. And then solar. Is solar still working for us well? I mean, I know the pumping charges and stuff,
Yeah, we actually, so I think we gave an update already for the end of the fiscal year. Because we do it annually, we actually update it and find out where our savings are. So we're the last I think we're saving about $140,000 a year for the solar, but that's at like no cost to us because we do the PPA.
That's right. Okay, so we did a PPA. We're not financing anything. We're not touching this PPA.
So we see the differential between what we pay the PPA and what we would pay SCG, we're saving about 140.
And is that an ongoing contract? Is there?
Yeah.
Is there?
There's a
sunset clause
time,
or
yeah,
anything
there's
in that?
sunset down there, I forgot if it's 20 years. Yeah, 20 years, and then we'll have to make a decision at that point.
And how long are we into it? Are we 10 years into it?
No,
Was that 2020, 2019,
something like that.
something like that? So we're
7, 8 years,
yeah,
6, 7
like
years
6
into it.
years into it.
Yeah.
Yeah, 6, 7 years. into it.
Creeping up.
We do have a decision to do with our district solar, because that's past its useful life, and that's not part of the PPA.
Okay, that's what I was wondering. Okay, so
That's separate, yeah, that's
strictly on site.
That's just on site, that pre-exists, that was like 2006 or something to that effect, but, and that's a decision that we'll have to come back to the board with at a later date.
Gotcha.
Yeah, we've got a firm that's given us options. We're waiting to get those options.
Thank you.
All right, so on the sewer, Jody.
Okay, so, excuse me, sewer end of fiscal year 24-25 with a 0.98% budget to actual variance, or
Good job.
over budget by 90,000. And this slide excludes treatment costs that are considered uncontrollable, and includes the SCADA costs of about 420,000 that Wes mentioned earlier on the water side.
So unfortunately,
So if we exclude the SCADA costs, sewer ended the fiscal year with a 3.61% budget to actual variance, or under budget by approximately 330,000.
so this one happened the opposite for me. I was excited at the beginning and then I got upset when it came out.
But that's still good for sewer.
Yeah.
Didn't realize this SCADA project covered sewer also.
Yeah, both sides.
It was less on sewer, it was like 400,000, but it was $1.1 million total for both.
It's metal arc and 3 lift stations compared to all of our pump stations and pressure reducing stations.
Okay, so this next slide shows what the 330,000 variance is made up of. Here again, the IT variance of 23,000 excludes the 420,000 for the sewer portion of SCADA costs. The other notable variances, engineering was 185,000 over budget, primarily due to more outside source costs than anticipated. And that is because the land outfall clearing and access road project was closed out, and $331,000 was expensed during 24-25 instead of capitalized. And then safety and compliance was 98,000 under budget, primarily due to spending less than anticipated in outside services costs. This department was fully staffed in 24-25, and so obtaining permits, completing safety and compliance checks, updating safety plans, they were all being completed by internal staff rather than outside consultants. And then G&A was under budget by approximately 177,000 due to lower labor costs, lower than anticipated legal costs, and 50,000 in savings in outside services due to the deferral of the sewer cost of service study. And then next we'll go over the budget calendar.
Well,
So
do we have any questions on sewer?
I don't know, I always have questions. Quick question on engineering. You said because of outside engineering, outside services. I mean, have we done, if we hire, because I saw we saved because we don't have an employee. I mean, have we done the analysis? Where's the savings? Using
Yeah.
outside services or doing it in-house?
We have, so in general, if it's within our capacity to do so, it's less expensive for us to do it in-house. But it's gotta be a 5-year, do we have work?
No,
for 5
meaning, like, if we hire 1 or 2 or 3 more employees.
Yeah.
Is it gonna be more expensive then? I mean, with payroll and benefits, then where's the cut?
That's what I'm getting
Okay.
at, yeah. So in general, if it's something that's kind of within our wheelhouse, we have the capability of doing, having employees in-house and doing it in-house, we actually save a little bit of money.
Mm.
But that decision's not that cut and dry, because if you have to have continual work, because if you have 1 year's worth of work, but that's not been the problem for engineering. The problem for engineering is we go out and advertise for engineers, and we get no qualified applicants. We get 1 qualified applicant. We get 3 qualified applicants, none of them end up being a good fit. So but some of the work has to get done, so we've had outside services. But the good news is, next week we have a new engineering manager starting, then we're going to be advertising a new kind of mid-level entry engineer. So we're trying to reload engineering slowly, because engineering's been short-staffed for
Since March of last year.
So burnout somewhere in there.
So I mean, we've had
Somebody getting overworked a bit.
we've had promotions. We've had promotion from below. We've had engineer leave. Staff is getting through it. We're using consultants to stop the burnout. But yeah, at the end of the day, we need to get this position and the other positions filled.
Gotcha. Thank you.
Oh, how about the outfall project? It's still 40 million.
This is, which one was this?
Yeah, this project is related to a legacy easement clearing project, 2009.
Yeah.
That
I'm talking about the future, the big
Yeah.
project.
that's still moving forward. We actually, just quick project update, PDR for that project will be finalized in a couple of weeks. From what I've told from staff, that the engineer's estimate is increasing, it's going up, right? Nothing ever gets cheaper. So yeah, we're still moving in
I
that
think it's gonna be
direction.
more than 40.
Yeah, but I mean,
It's still over.
and the
4 or 5
and the
years.
goal is to finish the PDR, get into the design, and then we can really kind of strategize. We'll work with Wes on, when's the appropriate time to take out debt to make it happen, and we can control that schedule a little bit to.
And that's still 4 or 5 years
Yes.
process.
Yeah, it's such a big project. We're gonna slice it and dice it,
Yeah.
so this way we don't end up having a fiscal drain on the district. So this way we time it out, because we do have development fees that we're collecting for that go towards that project, and we have lots of expenditures, and so we're gonna do a lot of design and everything up front, and then we'll end up putting out different bid packages, working with the finance team on figuring out what makes sense and when and if we need to go out to debt. And of course, we have to go back to the board for those final decisions.
And then the other one was the Legacy 2009, you said easement project.
Yeah, and again, it didn't create an asset.
We tried.
Yeah, I think we tried, and there was some involved coordination with other agencies, and so it was just taking a long time to come to the decision that we needed to expense it, that we weren't going to recoup.
Yeah, we're trying to build a road on our easement so we can access the facilities behind kind of Costco over there. And environmental regulations and everything aside, we were just not able to get it done.
So what happens with that is from 2009 on, all the expenses that we paid contractors and outside consultants and whoever else we may have paid, when we close it and expense it, it happens this year, and a lot of that would hit outside services because of the people that we paid through invoices and that. So that's why our outside services in 25 were off the budget.
Yes, we occasionally have these kind of weird jobs in engineering where we're not creating assets. Like, again, you think it's cut and dry with building pipes, reverted plants and all that thing, but there's these other weird projects with easements and things like that where we try to strategize, and we're working through environmental issues and this and that. Finally, we got to come to that decision.
Decides whether it can be expensed or goes to capital.
So we have to use accounting principles to decide that, so we have to look at it and say.
We can't make it up.
It's not a board decision.
Yeah.
It's like at the end of the fiscal year, we look through all the projects and we say, this one looks like it's supposed to budget, is it in use? And if it's like, well, we're not quite finished, we still have project final fees and blah, 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 like we have to close it, because.
It seems like studies are a gray area.
And sometimes I twist his arm a little bit, like,
Well,
hold on, we're
this
still
is
working on it, we're still trying to figure
This
it
is
out.
a-
All right, we'll
this is
have
a
the same conversation
generational
next
argument
year.
between engineers. This is a generational argument between
Oh, yeah.
engineers and accountants.
And yeah, it always will be too, but
Yeah.
we don't have a choice. The auditors come and they say, if we don't, they're gonna say, you have to do this, or we'll even ask them all the time, like, hey, we have a question about this project. And as long as we talk to them in advance, we say, hey, we've done some projects, we're on the fence about whether we wanna close it, expense it, so on and so forth. The auditors will work with us and we work through that, but it has to be done at the end of the fiscal year.
This project is an 09, so it's a legacy project. We're just trying to build a road that had to be maintained and updated, so it would have been an asset. But we were unable to do the road because we just couldn't get over the environmental.
It's so long ago, I think I bid on it as a contractor.
Do the work.
Was it really no 9?
Yeah.
Yeah. And it actually even predates that on different expenses, because my predecessor at the time in engineering, a guy named Ken Gertis, went over there to try and clear so we could build the road and put down rock, but then went into the environmental area because the surveyor and the people clearing couldn't find the survey stakes. And that's when the environmental agencies came in and said, you violated.
And it took many years from there to kind of, for the cost to, hit the district and to kind of resolve and try to figure out where we're going. So it wasn't like it was
Yeah.
a quick thing.
There's years that we didn't spend any time or money on it because we're just waiting for environmental regulators to get back to us. So.
Okay, moving on to budget calendar this month. We updated the budget worksheets with audited 2025 numbers. Individual departments are preparing the budget requests and submitting them to the finance department. And today we are having our first budget related committee meeting for the budget calendar. We don't over budget versus actuals. And then next month, department budgets will be compiled into the operating budget. Current fiscal year projections will be completed. Future personnel payroll estimates will be completed, and debt service forecasts will be completed. And then we have a meeting tentatively scheduled for March 17th to review operating budget requests. Director of Operations will be invited, and we will discuss board requested items. And in April, it will be incorporating the operating budget, first reviewed by the CFO, Director of Finance, and we'll continue to revise and refine. And then on April 9th, we'll have another meeting to review the capital budget requests. The Director of Engineering and Director of Operations will be invited. Preliminary salary and benefit estimates will be discussed. We'll review operating budget changes, inclusive of water cost estimates and revenue requirements. And in May, reserve projections, we'll be working on reserve projections, 5 detail years plus 10 consolidated years. And first draft proposed budget will be reviewed by management staff. We'll continue to revise and refine. And there will be 2 full board workshops in May. On May 6th, we'll have a draft budget update and discuss board requested items. And May 20th will be a first review of the proposed budget. And then in June, the draft proposed budget will be reviewed by management staff, revise and refine, and there will be a board meeting on June 3rd requesting approval of the recommended budget.
And this is a very similar, or it's pretty much the same layout as we've done several years ago.
Yes.
So calendar to keep us on track and provide tentative dates for meetings. So.
And it's been working. You wouldn't change anything.
How about determination rate increases?
Yeah, that'll be done during the revenue requirements. Once we get to that part of the budget, we're like, this is how much we're going to need for revenue. We can look at that and say we need to put in. A lot of it will be on the water authority, so we may even wait till after the budget's approved and then go with the actuals from the water authority, which is usually in our best interest.
Yeah, that's a good timeline. I mean, this will give us preliminary numbers, but I don't want to come to you and say we need a 7.2% increase, and then 2 months later, water authority doubles their thing. They say, oh, 9 needs 11.4. So it could be a good starting point, but I won't have numbers really for you till October.
Yeah, that's
September,
exactly
October.
it. It's fall. And we come back to the board in the fall with we've already had the 218, so it's basically recommended rates for starting January 2027. This is after we have the water authority's proposed rate increases.
We'll get the best information we can during this process and make our own assumptions as best as we can during that timeline. But it's going to be.
This coincides well with Encina. With Encina's new billing, is that been a lot better for budget? Or it hasn't affected it?
Well, here's the catch to that. Because the plant shut down, we're sending a lot more to Encina now.
Metal art shut down right now, so it's not normal operation for us.
So what we're seeing an increased cost in Encina. So first, that didn't click with me at first, and I talked to Jody. I'm like, Jody, what's going on? They're going to go way over budget. We need to talk to them. They need to come to the board, and they probably will still have to do that. We'll have to bring an explanation to the board, because if the plant continues to be shut down, they are going to go over budget and the funds won't be authorized. So we'll have to make an estimate of what's happening and come to the board and say, here's what. So the new billing, really, it's been hard to tell if it's been good or bad for us because it's been increased costs.
Oh, I see. Interesting. As far as just calendar wise, is it, in fact, I mean, do they come out with different numbers than we do? Is that,
Well,
I'm just wondering if we're collaborating and.
Yeah,
you know,
it's,
timing.
and seeing as rates go up and then they coordinate with us on that, on their rate increases, so
On a
we're
regular
aware of it.
basis, so it's not.
Yeah, and you know, from a temper, that's the main thing with the budget and the man, we look at trying to keep those costs to a reasonable amount, but seeing as rates are going up, really, it's similar to the water authorities, it's, you know, fairly significant, so.
That's what I was concerned, yeah. And it's all on energy, it sounds like. Energy. chemicals.
But they're always very good. They're collaborative. Like every time we have questions for them, we talk to them, ask what's going on. Aaron's been very responsive.
Thank you.
So June 3rd, hopefully get the recommended budget approved, and that's the budget calendar. Next, we're gonna move on to OPEB if everyone is throwing over their questions.
Moving on.
Oh, yeah, really quick, before Mike starts, if you have any conflicts of those committee dates, please
That
let
must be a
Kirsten
good
know so we can reschedule with staff, because the whole finance team is gearing to those are our dates, those are our kind of our doors that we go through, so everybody's collecting, funneling towards that next presentation. And so if we can provide you just a summary of all the dates, I think it may already be in the calendar, correct? So for the finance committee dates are already in the calendar the board has?
Yeah,
The
they're
board
already.
calendar?
they're already-
Yeah, the
Okay.
committee dates are, yes.
Yeah, but if you have any conflicts, please let us know right away.
It's fine. St. Patrick's Day, Green Day, looking to be talking money.
Yeah.
We did that a couple of years ago,
Yeah,
I
we did.
remember, because we had a graphic, I put a graphic of leprechauns up front
Oh,
on one of my slides.
The only thing green I have is Cal Poly stuff, so I'm gonna have to wear it underneath my stuff.
Proudly.
So,
Real quick, before we get onto the OPEB, just, you asked the question about solar savings, so I looked it up. We only do it, Wes mentioned we reconcile at the end of the fiscal year, so through June 30th to 25, the lifetime to date savings is about 491,000. And just for that one fiscal year, it was 101,000. So about 100,000, really depends on what kind of goes on during the year. It's
So the great news is as SCGE rates go up, savings go, our delta goes up. I don't know if you wanna call that great news.
It doesn't completely offset it.
Yes,
but-
it doesn't.
Okay, so the OPEB funding. So OPEB is the other post-employment benefits. For us, it's the retiree health. OPEB's a closed system. It's been closed since June of 2013. And then currently there's about 40 active employees, or about 40% of our staff has the OPEB. The other 60% don't have it. And there's about 25 retirees that are currently on OPEB right now. So the current retiree health cost, the cost for those 25 employees is about $400,000 a year. Goes up or down about $20,000 a year, and we pay it out of this trust, which I'll go over in a second.
When do they fall out of that? Just upon death?
So 65, they have other coverage. There's a couple other things that might happen. So if they get another job and they have
Yeah,
health coverage, they're supposed to let us know.
But it's
And they
definitely at
drop off.
65,
65 is the
65,
latest,
yeah.
or
unless another event.
Right,
Yeah,
unless there's another
yeah.
significant event that happens. So we have a CERP trust account. It's basically just our bank account. It's a California Employees Retirement Benefit Trust account that we have. It was established about 14 years ago. So just quickly, some of the definitions. There's a TOL, which is the total OPEB liability. So it's basically the present value of the benefits for past service. So for example, if everyone were to retire today, of those 40 employees, that's the amount that would cost us to pay for their retiree health through 65 or other event. So it's basically what we currently owe. So the FNP, the fiduciary net position, is the assets that we have in that trust account, that CERP account. So basically it's money that we have in the bank to pay for this past service. And the NOL, the net OPEB liability, is just the difference between the two. How much do we owe? How much do we have? What's the difference? The good news is we have more money than we owe. So we're overfunded, we're super funded in this account. I'll show you that in a second. So the present value of future benefits is the number I told you about. If everyone were to retire today, how much would it cost us to pay for those 40 people plus the 25 that are currently on there? It's about $5.5 million. And that's figured out by an actuarial who looks at our number of employees. Oops, life expectancy, interest rates, healthcare costs, and other things that are going out in the market today. So that's how that $5.5 million is calculated. We get an update of that every year, really 2 years. They estimate every other year, but every 2 years we get a full number. And it's kind of estimated the every other year on that. So the trust balance as of December 31st was about $6.1 million. We've put money into that since 2012, I think it was. So over the last 14 years, the district has contributed about $440 million. You should see our balance right now is already 608.
It's important to note that we stopped contributing in 2016.
Yeah, about 9-10 years ago, we stopped contributing.
It was fully funded at that point. We haven't put any other money into the fund.
So investment earnings over the lifetime has been about $3.85 million, or almost 5.9% return on that. Withdrawals. So I've mentioned that it's about $400,000 per year. We've been paying out of this CERT trust account for the last 5 years, I believe. So instead of expensing it through our regular budget process, we just take it out of this CERT account that's already in there.
So OPEB is costing us nothing.
Great, it's already fully funded. So here's just a history of it. So I should have brought in the blue bars and the green bars, but if you look at just the blue bars, that's our actuarial liability over the last 10 years or so. It's been fairly consistent. The biggest reason we'll go down is if people drop off at 65, or if we have any of those 40 employees that are not eligible yet and they leave the district. So if someone's 49 years old and they leave the district, they're no longer eligible, they would drop off of here.
Is there like a vesting?
Yeah, it's vesting 10 years and 50.
Yeah, you have to be at retirement age, so at least 50, be here for 10 years and retire from the district. So you can't leave here at 52, go work someplace else.
It's actually
You have to retire from the district.
And it's for only those people that were
Yeah,
Pre-June 30th,
yeah.
2013.
so it's one of the things that actually the employees picked to close shop in the MOU back in the day, So
real quick, the green bars are investments, and I just wanted to kind of point out because it looks like, oh crap, what happened? So it was growing up until 2021. 2022, I believe, was where the market really didn't do too well. Plus, it was, I think, the first year, maybe the second year, that we actually started withdrawing out of this trust fund. Prior to that, we expensed that $400,000 per year. In 2021 or 22 is when we started paying out of that. So that's why there's a big jump, a decrease in our assets in 2022. It was the combination of those two things. Right now, excuse me, we are about 110% funded, and the net balance, which is the bank account assets minus our liabilities, that delta right there is about $570,000. And then real quick, I wanted to go over, we've never talked about with the board or with the finance committee about our investment strategies. Through CERT, we have 3 investment strategies we can choose from. Okay, there's option 1, 2, and 3. CERT 1, 2, and 3. Right now, we are in strategy 2. Okay, so it's just the kind of level of conservativeness that we've chosen. It's always been level 2. I'm proposing that we kind of revisit this with Wes and I and James and kind of revisit it and bring it back to the board. We might want to change our strategy. We defaulted in 2 because it's the middle one, and we stayed at 2. We've never really looked at it. Well, I've kind of looked at a little bit of the history, and it may make sense to go into investment strategy 1. What I want to point out here, here's the 3 different investment strategies and what they invest in. The strategy 1 is a little bit less conservative, so it's investing a little bit more in the global equities, right? And less in the fixed income. Really, that's the biggest difference, is switching from global equities, less global equities, more fixed, less global equities, more fixed. The one thing I want to point out here on this chart, it shows you the aggressiveness, I guess, on here. And you'll see the more conservative is strategy 3. You'll see that this doesn't say more aggressive. It says less conservative. Everything by default, because we're a government agency, because they know everything is pretty much conservative. It's kind of like in your 457, you have your target date funds, 2065, 2055. One can be a little bit less conservative than the other, doesn't mean it's aggressive. Those are all built to be conservative by nature. So I kind of wanted to point that out. If we were to recommend to go to strategy 1, it's not that we're being risky, overly aggressive. It's just we're being less conservative.
And is this strictly for the OPEB funds or?
These are only for the
Strictly
OPEB
for the
funds,
OPEB.
yeah.
Not only we have this sort of option for PERS.
And we're managing those aren't outside, those aren't managed by anybody else?
These are managed through the CERT account. So it's a pooled fund, kind of like PERS,
with options.
but with options. And we always love options.
This return, you said 5.8 something.
Yeah, I have it on the next graph, so I'll show you. So I wanted to kind of show you. I'm not asking for a recommendation here. I just kind of wanted to bring it to your attention that we might be coming back. I don't know exactly what we need to do, if we have to get a board approval to do this, but it's just, I just wanted to keep it in everyone's mind.
So if we're, I mean, say we do well, I mean, with the investment strategies and we're, like you said, we're fully funded, we're making money. Can we realize some of those if we make, if there are certain amounts like, hey, we're overfunded, we can realize those and offset or anything?
So I've looked into it about 5 years ago, and I forget the full answer on that, but it's not a use it or lose it like if you put in your FSA account. We can use it for other things, but it has to be healthcare related. We can use it to potentially pay down current employee, our current year's expenses for healthcare that we pay to
If we do well in
JBIA.
the investments.
So,
Right.
so that's exactly it. So, and that's, I don't remember all the rules too, but I remember when we first did this back in the day, and that question was, I believe, asked, and the answer was, yeah, it could be used for other healthcare expenses for the district. However, you wouldn't really realize that until your liability windows get so small, because you have very few people in that group, that there's no risk of overdraw. So it can be, but you're looking at a 20 plus
years,
year
yeah.
horizon from now before that's a potential. It doesn't mean it's still not a good potential. This will always have healthcare expenses at some level for existing employees. And to be honest, the less conservative strategy is probably still more aggressive than what we do in the investment market through our normal. So,
Gotcha.
Yeah,
And the peak is at 40-25. We're not, that's gonna be the maximum we're gonna have, right? 65 employees. Because it's-
yes, yeah,
It's only
because
gonna
you
start
can't add
whittling down.
anybody, it's only gonna
Right.
dwindle, yeah.
Okay.
So real quick, I wanted to show you the 3 investment strategies real quick. So strategy 1, strategy 2, strategy 3. And this is just a kind of like a prospectus type thing, showing the returns for the last 3 months, what is it, 3 months, year to date, 1 year, 3 year, 5 year, 10 year. The normal outlooks that you see on any kind of prospectus or fund. We are in the middle one. And you'll see it even in the 5 and 10 years, 470 and 7% on the 10 year. On the 5 year, it's about a 1.1% higher in the 5 years, and about 1.4 or 1.7% higher over the 10-year period.
So it's more of the long-term stock market return.
Yeah, yeah,
but there's no guarantee past results will yield future
correct.
yields. So
But I mean, the good thing is, I mean, looking at all of this, they've all been positive returns. You know, sometimes you go and you'll look at on a 457, not the target equity date funds, but on a high growth, whatever, you'll see 3 years minus 7% because it really took a downturn 3 years ago. These are all pretty stable.
Yeah, I was gonna ask that, because sometimes these may be 10%, they're like 8.74%, but may have hit, like PERS, it's 21 year, right, it's, you know, 5 the next year, and so it kind of goes, I don't know if this fluctuates as much as that, it sounds like it's smoother.
Does not. I track this every month for the last 11 years, and it's,
yeah, and that's a question that staff needs, because I do have some concerns of sequence of returns risk. Because if we have 2 bad years in a row while we're withdrawing $400,000, it would make a huge differential in what the outlook of the actuarial is. So that's something we have to talk about.
yeah, so it's just a conversation point. It's always good, just like when we're looking for our contracts and stuff like that, that we've had a contract with this vendor for 5 years. Well, it's always good to kind of look at it. We may still stay with that same vendor, but it's always good to kind of look
Is
at
there a
it.
cost to change?
Just an option.
No, just an option.
But overall, I mean, global equities don't seem to be too risky, at least in my mind. But the
Right,
most
because
risky
you're
thing I saw there would be the REITs. right?
Yeah, the REITs, the real estate investment trusts.
That's what would make me the most nervous of all that, so. But
Reasonable,
overall,
acceptable, yes.
So it just goes up 3%.
Yeah, they're only 3% difference. Guys saying your biggest difference is just going from fixed income into global equities. And then what I did real quick is, so we had the 5.9% was our overall return. Again, these are averages, right? Ours really depends on when you put money in, when do we take the money out in July, I think we take money out, or June. We pay in July.
no, it's June, we have to put in the.
We have to do it before the end of the fiscal year. So really, it's a tiny thing. We change your percentages a little bit. However, over the 10-year period, if we did earn 1.74%, each percent is about $1 million. So that 1.74%, had we been invested in option strategy 1 and had everything happened the way it has, it's up on here, we would have had about $1.75 million more. Conversely, had we been in strategy 3, it's about 1.4% less. It's about $1.25 million less we would have earned. So we're mid right now. It's good, but it's just a talking point. That's something that we should at least look into.
We're an upper tier agency though. But we gotta be in the upper tier, not the mid tier.
So there's trade-offs.
Top-
So like
tier.
like James mentioned, you know, if you have 2 bad years in a row, that 110% could go down to 85 to 90. Do we want to do that? Have we had 2 bad years? I can look at that. Like I said, I have about 120.
These are your numbers that you've been tracking yourself?
Well, this comes from CERT, exactly from CERT.
Okay.
But I have numbers that I track. As a matter of fact, I track the daily balance, and I know the daily return rate for the last 11 years.
Yeah, if you look at that 10-year average, right, that's a 10-year average, and it doesn't really take into account what would happen to our account. If you had 2 bad years and we're thinking $400,000 a year out for 2 bad years, you know, you're taking more shares out basically, because as your share prices go down, so that sequence return risk can be significant, even though you'll probably still gain, you know, 8-something% over the next 10-year average. But now that you have so many less options or shares, your gains when it does gains, right? So that in the first couple of years, having bad years really could just torpedo your investments. And then our remedy for that is actually take money out of our reserves to fund that account. So that's something that we may be risking. So this is something that we definitely need to look at. But
conversely, if you had a really good year, then you
Absolutely.
gotta get a little bump.
absolutely,
It's the
Yeah.
risk reward type thing.
Yep.
So.
yeah, we change it in next year's 23%. We are geniuses. We change it in next year's negative 23%.
Somebody else's
People
fault.
are gonna be.
So if it goes up, James said, if it goes down, Mike said.
No.
But just real quick, just over the
In the
last,
door is what the board says.
I have almost 10,000 data points on here so far.
You said they've been all positive. There hasn't been any negative.
No, there's been negative years, but it's been like -3%, and it's bounced back the next year. The lowest we've been at is 4.25% overall, and then the highest, not counting the first couple years because those don't really count. There's not enough data points. Is about 7%.
Is that 4.25? Is that in like 21, 22?
Yep.
Well, and what makes me nervous about this too, those 10 years include the COVID times, which were pretty crazy.
So we'll take a look at it. We'll come back to committee or the board with a recommendation and be able to give you more data and answer some of these questions we haven't answered yet.
Just for information. Mike looks into everything.
Very good information.
So I think that is.
How many computers have you worn?
It's only my second one in 11 years.
I went through 3 in the last 4 months because they were all like 11s.
Recalls.
Making lemonade. Questions? Any other questions, comments, any other information?
Budget season started.
Well, thank you, everybody, for being here. Kirsten, thank you. If there is nothing else, meeting adjourned.